Once we are able to beautifully discuss these introductory issues, get all of them out of the way, 20 marks done and dusted, we now come to, the big aspect of the discussion, which is the IFRS masterclass. And so this is where you're going to be looking at the various accounting standards. And you must understand that when it comes to financial reporting, the accounting standards are the pillars that hold the entire subject. Why? Because we will have a 20-mark question on the accounting standards. Then we'll have number 3, single entity financial statement. If you are preparing statement of profit or loss and other comprehensive income, statement of changes in equity, statement of financial position, or the cash flow statement, all the footnotes there, we have to apply the accounting standards. And so we have 20 marks dedicated on the accounting standards. Then we have 20 marks applicable to the single entity financial statement preparation. Even when it comes to number 4, that is evaluation of financial statement, it's important you understand that the accounting standards are going to be chasing us down here depending on the context of the question. Why? Because sometimes the examiner can give us a set of financial statement with some footnotes, which will require us to then adjust the financial statement. The way we adjust the financial statement will depend on our understanding of the accounting standards, because we have to apply the accounting standards to the footnotes. Then we can do the necessary adjustment before we calculate the ratios and interpret it. Then the 5th thing, consolidated financial statement, that also you must have the accounting standards there, because some of the footnotes when it comes to consolidated financial statement, we will have the accounting standards there. And so the accounting standards then become what? Pivotal when it comes to the financial reporting examination. And this is also seen even in corporate reporting. The accounting standards plays a key role even in the corporate reporting examination. And so what are the accounting standards? We've gone through this before. I'm going to be bringing it up again. So we have the non-current asset standards. Please note, as I tell you always, it is important you understand that you understand what the examiner is going to be doing to you in the exam hall, the structure of the questions in the exam hall, so you can put yourself in the position to ultimately pass the examination. So the big question you ask yourself is, okay, when it comes to the accounting standards, what am I looking at? All right. Non-current asset accounting standards, whether you like it or not, there is going to be something about them, either dedicated specifically, or there will be a footnote that will require you to apply them. And this is where we are talking about IAS 16, property, plant and equipment, IAS 23, borrowing costs, IAS 20, accounting for government grants and disclosure of government assistance, IFRS 5, non-current asset held for sale and discontinued operation, IAS 40, investment properties. So these are non-current asset accounting standards. Whether you like it or not, these 5 accounting standards, you will call on either 2 or 3 of them in every examination. Again, either as a dedicated question, or the principle will be applicable in dealing with something else that is another accounting standard or a certain footnote that you are applying. And so the non-current asset accounting standards, very important. You must understand them very well. But connected to these non-current asset accounting standards are other sets of accounting standards that you can see on the far right side, and that is IAS 37, provisions, contingent liabilities and contingent assets, IAS 36, impairment of assets, IAS 38, intangible assets, IAS 12, income tax, very important, and then IAS 21, effect of changes in exchange rate. Now, for those of you writing, we are in financial reporting, right? So for financial reporting, whether you like it or not, you are guaranteed on IAS 16 and IAS 12, at least. So at least these 2 accounting standards is a done deal. It's waiting for you in the exam hall. Because whether I like it or not, you will deal with IAS 16. Whether I like it or not, you will deal with IAS 12. So these 2 accounting standards, you must know them. But you see, the beauty of the standards, as I mentioned, is that they are intertwined. So, for instance, we could start the broader discussion with IAS 16, property, plant, and equipment. Now, when you take almost every accounting standard, one of the things you must understand is the issue in respect of key definitions. So, when you pick most accounting standards, key definitions, okay? Because there are terms that we need to understand, terminologies that we need to understand when it comes to the accounting standards. Number 2, you must know the objectives of the accounting standards. Number 3, you must look at the initial measurement and recognition. Or before initial measurement and recognition, let me talk about initial recognition criteria rather. So recognition criteria. Okay, then initial measurement and recognition. Okay, now you know the difference between measurement and recognition. Measurement is simply the monetary value at which a transaction is carried in the books. Recognition is simply the incorporation of a transaction into the financial statement of the entity. And so initial measurement and recognition. Next, you come to subsequent measurement. All right, subsequent measurement. Then the last thing is going to be disclosure requirements. So when it comes to the questions the examiner is going to be asking you, he can come from anywhere at all. At least the first two, we can ignore the first two a little bit, but the last 4 are crucial. So the examiner can come for you in recognition criteria. He can come for you on how something should be initially recognized. How would you know? Because the dates for the period that you are recognizing the item will be initial recognition. Or sometimes it has to be subsequent measurement. So you're going to do both initial recognition and subsequent measurement for the reporting date. Then the third thing is going to be disclosure requirement. So in respect of a certain accounting standard, what has to be disclosed in the financial statement or in the notes to the financial statement. So these 4 things are crucial. Almost every accounting standard you pick, you must ask yourself, what is the recognition criteria? For instance, when it comes to provisions, what's the recognition criteria? Okay, if it is rotten, you provide for it. So rot, meaning that the amount is reliably estimated, or there is a present obligation. T, transfer of future economic benefit embodying the entity, or the settlement of which will result into transfer of future economic benefit. All right. When it comes to assets, when do we recognize assets? We recognize assets if the cost can be reliably estimated and it is probable that the future economic benefit will flow to the entity. That's it. Right. So when you pick the standards, initial recognition criteria, initial measurement, subsequent measurement, disclosure requirement, every accounting standard you are learning, you must know these 4 things. Because the examiner can come for you in disclosure, which is reading theory aspect, or on subsequent measurement, which means you are going to be doing recognition and then the subsequent measurement in that regard. So when you pick something like IAS 16, property, plant, and equipment, divided into 2 broad areas, we have the initial recognition and then subsequent measurement. Okay, initial recognition and then subsequent measurement.